us on the phone line. Peter, thank you so much for taking out time for us. First, a quick reaction of what do you make of the Fed minutes broadly in line?
Well, yeah, I mean, they were a little less hawkish than I expected, but nevertheless, the bond market interpreted as a hawkish, viewpoint, and of course, the 10-year note actually shot up above 94, above 294. Actually traded around 295, and so at that point, I think equities began to reflect what the bond market was reflecting, and basically what it was all about is simply that the Fed is going to raise rates this year, and I suspect that they're going to raise rates a little bit more than what the market has priced in. If you look at the minutes, they seem very optimistic about the economy. They certainly highlighted inflation and said that 2% inflation this year, which is the Fed target, will likely be achieved. And I think that's the key. If the economy continues to actively progress, then the chances of inflation topping the Fed's target is real, and that simply means that the Fed is likely to be more aggressive later on this year. Instead of maybe 3 hikes as the market is priced in, we could be looking at 4 or possibly even 5 hikes, and I think that's why we had the late drop in stock prices, and probably this could signal that 3% on the 10-year note is upon us, and that probably will induce the market to have another leg downward, not necessarily breaking the lows that were established a few weeks ago, but certainly retesting them.
Right. But overall, if I look at the commentary that is coming from FOMC minutes, it's balanced overall. It's not that it's pointing out that there will be aggressive rate hikes at this point of time.
Can you repeat that?
I'm saying that the overall commentary which is coming from Fed minutes, one can say that it's a balanced view, not a very aggressive one for rates.
No, yeah, as I said at the beginning, it was mildly hawkish. It wasn't overly hawkish, but it certainly indicated that the Fed is prepared to rate hikes. And, of course, depending on the state of the economy, and the key, of course, is inflation, it's a good indication, as I said before, that the Fed is likely to be more aggressive. Now, we have a new Fed chairman, Powell. He's basically indicated that he's going to follow the policy that was put in place by Yellen. But by the same token, he could be more alarmed about the prospects of inflation than Yellen was. And so I kind of suspect that, while not many members were worried about the economy overheating, that possibility, due to the very tight labor market, could be a surprise for the Fed. And if it were to be a surprise for the Fed, that would take us back to what I said a few moments ago, that the Fed is likely to be more aggressive.
Right. The more interesting thing will be what happens with tax cuts and the global momentum in growth. That'll actually more determine what's happening as far as rates
Well,
rather than only this commentary.
that's a good question because the global economy is doing well, and if you look at the European economy, the EC economy is growing rather rapidly, but the difference between the economic growth uh, in Europe and some other parts of the globe is that uh, the American economy is growing at a fairly good pace of economic activity, but has no employment problem. Employment is very low. We're at 4.1%, and that's basically full employment because that 4.1% has, is included with people who can't work, people that don't want to work, and people that are just basically out of the job market because of the fact that the job market has changed, and of course types of industries which are more geared towards technology just doesn't offer them an opportunity. So basically, we're at full employment. And so the difference is that the American economy is growing strongly with full employment, while the EU and some other parts of the globe are growing, but with high rates of unemployment. So the chances of inflation perking up here in the States due to the tight labor market, and of course we did see some wages actually begin to perk up in the last labor report, that's a concern going forward. And I suspect that we'll probably see another round of wage increases in the next coming unemployment data.
Right. Just a word on the 10-year yield. What do you think is the cap? 3%, 3.1 current levels. What do you think is the cap as far as these yields are concerned, at least in the near term, or what is market trying to price in at 2.9%?
Well, I think in the near term we're looking at 3%, which is we're not that far away. And of course, I think once we reach 3%, the equity market is probably going to discount that. And that's why I say I think we're headed for another leg downward. And then, of course, it depends on the economic indicators, how strong they are. Now, tomorrow we have the leading economic indicators, and if they should be anything like they were last month, I think we could probably see the 10-year trade up to 3%.